What happens when the guardians of global monetary policy shift their strategies unexpectedly? A question that has been looming large in the minds of economists and policy analysts alike. Central banks around the world, from the European Central Bank to the Federal Reserve, have increasingly taken on the role of central planners in recent times. They seem to be engaging in a coordinated effort to shape monetary policy and economic narratives, all echoing a unified message aimed at tackling inflation. Their approach? Higher interest rates for a longer period. This synchronized maneuver aims to cool down overheated markets and reduce inflationary pressures by potentially increasing unemployment. The target? To bring inflation back to the golden figure of around 2%. But then, a surprising twist emerged. Jerome Powell, the Fed Chair, signaled a potential policy pivot. This shift from a hawkish stance to a more dovish tone marked a significant deviation from the previously synchronized rhetoric of central banks. A deviation that raises questions about the underlying reasons for such a change, especially when other central banks maintain their hawkish outlook. Could Powell's shift be driven by urgent concerns over the health of the U.S. economy? Or by the challenges posed by a strong dollar, especially its impact on countries like China? The possibility that the U.S. economy is weaker than previously thought, or that the high dollar index is causing significant distress in other nations, could have prompted this sudden pivot. The implications of Powell's shift are significant. The historical context of Fed chairs and their legacies is a weighty matter. Will Powell be remembered as a figure akin to Paul Volcker, known for his decisive action against inflation, or will he follow the path of Arthur Burns? With inflation still above target levels, this pivot suggests that Powell might be privy to information indicating substantial economic risks ahead. The bond market seems to echo these concerns. Its inverted yield curve signals potential economic downturns or even a recession. This extreme inversion, often a precursor to recessions, could be foretelling significant economic disturbances. Adding another layer of complexity to the situation is the global reliance on the dollar, particularly in international debt and trade. The behavior of the dollar index in relation to other currencies and the dynamics of dollar-denominated debt in the international arena play a crucial role in global economic stability. The recent surge in the utilization of emergency measures like the Bank Term Funding Program, particularly in response to banking stresses, underscores the fragility of the financial system. This spike to unprecedented levels indicates underlying vulnerabilities that could have influenced Powell's pivot. As we navigate these tumultuous waters, the decisions made by central banks, particularly the Fed, will shape the future economic landscape. The coordination among central banks, their responses to inflation, and the management of the dollar's strength will continue to be pivotal factors in maintaining economic stability and averting potential crises. In a nutshell, the recent changes in global monetary policies have created ripples that could turn into waves. Central banks' coordination, their inflationary responses, the strength of the dollar, and the utilization of emergency measures paint a picture of a global economy on the cusp of significant change. It's a complex and challenging landscape, but one that holds the potential for profound insights into our economic future.